Is this the start of a real correction?
That's my guess. I think we might trade down before this is over, eventually down to around 1,800 and get close to that 10% correction. My concern, I know that people think this is caused primarily by increasing concern about global growth emanating out of Europe and what it might do overall. But I think the bigger risk still is that the U.S. economy remains pretty good, and now our resource markets have tightened up, so the unemployment rate's in the 5s, factory utilization's headed over 80%. I think that where the bigger fear is that we now get a scare on inflation or the Fed behind the curve, and rates have to back up sooner rather than later. And if we do that in the context of worried about global growth, I think that could be enough to send us down towards that 1,800 level. So I'm still in a bull longer term, Trish. I really am. I think there'll be a great buy here at some point for the next few years, but I do think we've got more turbulence.
Okay, a little more turbulence. Do you believe that we're going to see a spike in the VIX as well?
Well, I think what's happening is that the low economic growth world is becoming consensus, but how to invest in it is not. And I think that's what's really generating the volatility. And so for now, we don't know whether we should worry about higher interest rates if, as Jim says, you have an inflation scare, or if you worry about a flatlining global economy because Europe is falling into recession, Japan's not really working, emerging markets are struggling, and we here in the U.S. we're doing okay, but it's okay relative to a lot of lousy other places. So all in all, I think investors are really kind of confused, and you're seeing that in the market action.
Nature abhors a vacuum. I thought you were going to do your Betty Davis at the top of the show. Fasten your safety belts. It's going to be a bumpy ride. Nature abhors a vacuum. We haven't had any real news to trade on except the minutes of the Fed meeting, which was 3 weeks ago. Since then, the data have been better. So there isn't a lot for people to hang their hats on. Next week, we start to get earnings. Later in the week, we also get retail sales. If numbers start to come in again on the economy, they're good. If earnings start to come in good, then people may start to see the U.S. as a good place to invest again and get back on their horse. Now, maybe Jim disagrees. Fortunately, he gets paid to make predictions.
I'd be surprised if some of those retail numbers look good.
And I've got a thought on that, and that is that the Fed really spooked the markets by saying it's worried about a strong dollar. Because what that tells the rest of the world is that, hey, guys, you're on your own. You cannot rely on U.S. consumption to bail you out. And I think that's what really spooked the markets. The Fed already is saying a dollar that's barely off its lows, if you look on any kind of long-term chart, is too strong. And I think they're saying that because the one part of our economy where jobs are being generated is manufacturing. And what happens to manufacturing when you have a strong dollar and you're competing in a world on price because there's no demand?
Right.
Then your manufacturing suffers. And I think that's what the Fed is seeing, and that's what really scared the markets.
Couldn't you, if you were really worried about a strong dollar, just put a little more QE into the system? Jim Paulson? I mean, I'm not saying that's a good thing, and I think you know me well enough to know that I don't believe that that's the answer. But if you were really worried about the dollar being too strong, you could just print a little more money.
Yeah, my feeling is there's three really strong consensus opinions right now. One is that the U.S. is the place to be. Second one is the dollar's got nowhere to go but up with the Fed exiting the scene and others easing. And the third one is yields are going to remain lower for longer. And I really think, Trish, that every one of those consensus themes got a good chance of being disappointed in the next year. For example, I really like the European story right now as far as a stock investor. I think it's a great opportunity to move some out of the United States and move towards Europe in the midst of this panic. I think it's gotten bad enough over there that we're going to start essentially Draghi 2. The first Draghi 1 was in September of 2012, and the European markets did a lot better after that for about a year or so. And I think we're now going to get Draghi 2. And I think if that occurs and Europe gets better, Euro gets a bid, the dollar weakens off, you not only get a better European stock market, but better repatriation currency translations when you come back to the United States.
Well, you think the Euro gets a bid. Isn't Draghi's goal to weaken the Euro?
I don't think it can. I mean, it's interesting to me. What I find interesting is I believe that the world's developed countries' currencies are effectively pegged together. Take euro and dollar. It's been in the same trading range for 10 years, and it's near the low end of that range, around the 120 area. And if the breakup of the Eurozone, which everyone thought is mightily possible a couple years ago, wasn't enough to take the euro out of that range, I don't think the slowdown currently is enough to do it. So I really like buying the euro, if you will, down here in the low end, almost on the low of its 10-year trading range against the dollar.
I'll take the other side of that. I think the way to play Europe, I agree with Jim on the idea of buying Europe. I think Europe is cheap, Europe is very underowned, and Europe is probably priced for a lot of the risk that's there. But what I do think is going to happen is the euro is going to have to weaken, and weaken significantly versus the dollar, and it's a matter of pace rather than direction. And so the way to play it is not straight euro exposure. This is where Jim and I would differ, but unhedged. You know, I would hedge out the currency.
You hedge out the currency, and then you go and buy some.
Buy Europe, and I would also add to that, I'd buy Japan. And there are vehicles with which one, even the individual investor can do this and buy a hedged European equity.
I mean, look, because your average investor, you talk about hedging.
ETFs.
So what kind of...
You buy, I can give you two symbols right now. Help me, please. Lift me up a little bit, because I own them, and they've been painful. And that's the thing about Draghi, too, is that, you know, they're asking us for patience, right? We got to see how this works and that works. And while we're being patient, it's also painful, because we are suffering in these markets. But two things for people to look at. HEDJ is the hedged European equity.
Wait, say that again.
H, Harry, Edward, David, James, HEDJ.
I wonder if we can get a chart of that.
Yeah, get a look at it, because it's pretty interesting.
HEDJ, guys. Maybe
and then the other one is DXJ, which is for Japan hedged.
DXJ.
Yep, and those are the two vehicles that you can play. If you like Europe and like Japan, you want to be outside of the U.S. The U.S. has been the big outperformer. You sell the U.S., I agree with Jim, and you rotate into the other markets. Do you think this could be another
like 2008 kind of moment but for Europe? Maybe post 2008, maybe 2009. So you're getting in at a low level.
Well, I think you're getting in at a low level. Why it's not like 2008, 2009? Because people already know that Europe is depressed. People already know that it's not growing. But what's happening is that I think the banks are being slowly healed, and the banks are where I think you have the best opportunity, because the banks have to work for Europe to work, and that is they trade at less than 1 times book. They are going through their stress tests and their asset quality reviews, and I think those things over the next couple months are going to say to people, those banks are safe, because the ECB in November 1st takes over responsibility for the European banks, and that's why these stress tests are different than past ones. The ECB is going to say, this is good to buy, and you're going to go ahead and buy them, and Draghi's going to do QE, starting, I think, in the first quarter of next year, and you're set up for Europe to outperform the U.S. in 2015 on a hedge basis.
Jay, I agree with most everything you're saying except for the currency story. Let me just give you a little different story on the currency story, beyond just where the relative values are now. Everyone assumes that the dollar is going to strengthen, the euro is going to weaken, because the ECB is going to ease and the Fed is starting to tighten. And I totally agree with all that scenario except for the outcome. I think let's look at it isn't so much what the policy officials are doing that affects the currency rate, it's how they're perceived. So let's say in the United States that the Fed tightens because there's a panic about the Fed being behind the curve and there's overheat and we get a bad wage number in one of these job reports. If we're tightening because we're trying to catch up, that's a destructive force for the dollar. Not an accretive, but a destructive force. Let's say in the Europe land, let's say the ECB eases, but it's looked at as promoting a revitalization of growth. That could be a positive for the euro. So I think we're going to have the policy officials go opposite directions, but I think the outcome in the currency could be entirely unexpected.